Good morning and welcome to Fast Market. It's Friday, October 18th. I'm Alex Coffey and I'm joined on set by Jenny Horne and by Scott Bauer, the CEO of Prosper Trading Academy. Scott, thanks for joining us this morning.
Of course.
Happy to have you. We got a little bit of volatility here this morning with the S&P is down 29.91 and a quarter, and it just seems to be that same old story where there seems to be a little bit of a lid around this 3,000 level, and every time we get to this level, a little bit of resistance is met.
No doubt. We've seen that multiple times now, and at some point it's probably just going to break through. And in my take on this, Alex, is with volatility so inexpensive, and I'm looking at VIX right now, it is up 4% today, so it is trading back in the 14 handle. However, vol is really cheap for everything that's going on in the marketplace, politically, geopolitically, Brexit, interest rates, this, that, and the other. So something that we talked about forever on the floor when we're trading on the floor is you buy protection when you can, not when you have to. So what that means is people that are still in the market holding long strategies, holding long investments.
Which is the majority of investors.
Absolutely. Buy that insurance when it's on sale. And I don't think it's at a 50% discount right now, but insurance, if you want to look at the VIX or even we just talked about on the panel about the volatility in the S&Ps, it's very low. Buy it when it's cheap.
Yeah, and I'm glad you bring this point up, and I do want to continue this conversation for just a second before we dive into some of the headlines and what's going on next week, because I think it's an easy thing that people say all the time, Scott, but they don't necessarily know what you mean by that or how you do it. So when you say buy insurance or buy protection, are you talking going into the S&Ps and buying some puts at the money or out of the money? Are you talking about buying VIX calls? Are you talking about selling futures, or is it a little bit of all of the above?
In my world, I probably wouldn't do the selling futures part of it. I would probably go in and use some of the other derivatives, like buying some upside calls in VIX, which are very cheap right now. And I wouldn't do them going out 1 week, 2 weeks. I'd probably go out to at least November or December, because the relationship is inverse, right, between the VIX and the market. Market goes up, VIX typically comes down, vice versa. So you'd look to buy some upside calls. Or you can go to the S&Ps and you could buy either at the money or some slightly out of the money puts, maybe 5%, 8% below the market here. Premium levels are too cheap not to have protection.
Yeah, one thing I always say is obviously the clearest hedge or the easiest hedge is if you're worried about a position, you don't just lighten up that position or take it off. But for various reasons, maybe that's not an option or something that people are interested in. So what you're talking about is ways to use some of these products that are the overall market and using them to protect a portfolio that may lean a little bit more to the bias on the long side. One way that you're mentioning it is going out, a month or so into the VIX and buying some calls here. But when you're looking to protect a piece of the portfolio, you're also just doing this with a small chunk of capital, not necessarily half the portfolio or anything, correct?
No, absolutely. You're correct on that. So if I'm an investor and I've got let's say 30% of my net worth in the market, directly related to the market, I'm not going to hedge all 30% of that, right? I'm probably going to look to hedge some portion of that, maybe 10, 15% of that, because over the long run, the market still is going to go up, right? But these types of protective trades are more shorter term based, maybe 2 months, 3 months. You could go out further than that, but there's so much geopolitical risk, so many other things in the marketplace right now. I think someone's really got to look at that.
And to your point, when you're talking about expensive versus cheap, or buying it when it's when the house isn't on fire in a way, look at the VIX over the last year. We are on the lower end of the range. Like it or not, with what's going on, it is the case here with the VIX trading in the 14 and the spot VIX. Surely it's been down to 1103 at its low point in April, but kind of just tagged that level. Really, the low's been around mid 12s. Obviously, with the high last December up at the 36 handle. So to your point, very much in the lower end of this percentile. But Jenny, diving in here, I don't know if you have thoughts on any of that, or if you're just kind of taking this all in. But really, the big piece here is, to Scott's point, is there potentially is an opportunity to get some of these hedges off there at lower prices, at an opportunity like right now, than it is when things are kind of already falling apart.
Right, and I completely agree with you. I mean, I think it's shocking to me that the VIX is only at 14 with all the headlines we've seen today with China's sluggish GDP. We've also seen these tariffs come on from the EU. So it's surprising that this is only at 14 to me.
Yeah, I think that's Scott's point as well, and so.
No doubt about it. And one other strategy, people could say, all right, I'm going to just sell maybe some call spreads like in the S&P or something up above. However, you don't necessarily want to do that when premium is cheap, because then you're not able to collect as much money. So you have to look at the balance there and say, okay, what are the premium levels of buying versus selling protection?
Yeah, and in a way, too, that's actually selling the VIX kind of inherently when you're selling those call spreads because you're short volatility in the SPX there. But looking ahead, obviously, we kicked off earnings season this week, and it's been a pretty strong earnings season. Obviously, the reactions have been somewhat muted, a lot of moves inside the expected move, but we got even bigger names next week if you start thinking about some of the ones that are coming out.
Yeah, next week is a jam-packed calendar for earnings. I mean, Monday we kick it off with Halliburton. Tuesday we have McDonald's, Procter & Gamble. Post-market we have Snapchat, Chipotle, iRobot, Skechers, Whirlpool, and these are just some of the names that I liked. So I was just looking at my personal favorites. And Wednesday we have Boeing, Caterpillar, we have Tesla, Microsoft, and then Thursday Amazon, Twitter, 3M, Southwest, Visa. I mean, the list just goes on and on and on.
Yeah,
it's too much to pick from
Amazon,
the list.
Microsoft, Tesla, AMD. I mean, there's a lot of widely watched and widely traded names next week. You get durable goods on Thursday for economic data. But we did get some earnings this morning as well in Coca-Cola and in American Express, Jenny.
So Coca-Cola reported really strong earnings. They basically said that Coke Zero is driving revenue growth, which is exactly what Megan Brantley of Folio said yesterday, that these low sugar drinks are doing really well. And the stock is up, you see 2.5%. This was kind of the winner of the day, in contrast with American Express that posted revenue beat, earnings beat. They raised I think they maintained their full year guidance, and their stock is down, I think, something of, I mean, it's ridiculous to me that they basically had such a strong report and the stock's down.
So I want to get Scott's thought on this, because my thought maybe is that, this stock's just had an incredible year and the bar was just set so high that even beating wasn't enough. We are long a call spread for next week, the 118, 122. We are still in this trade. We're going to hold it through the weekend and this example trade and look to maybe get an opportunity next week to take this off on a bounce if there is one. Of course, nothing guaranteed there, but pretty strong report to Jenny's point here, Scott. You see a stock that's down 1% though.
I think the big key here was that they maintained their guidance.
Mm-hmm.
They didn't raise it. They didn't raise it. Now, like you said, Alex, expectations were high and they met all of those metrics. However, they didn't increase that guidance. So I think what you see here are probably just some investors maybe taking a little bit off the table that have been in this and been able to profit over the short run in this stock.
Do you think this could be a theme with earnings going forward? You could beat on EPS, you could beat on revenue, but if you're not raising your guidance, these stocks are forward looking, right?
I think AXP may be one of the outliers actually with that, because expectations, like you said, have come down pretty much across the board, but many companies have not gone in and already kind of raised guidance ahead of time. So if we see other companies come in and say, you know what, we're going to maintain our guidance, we're not lowering our guidance, I think that may actually be a positive.
Well, and to your point, too, if you look at this price action, the stock pops on the news initially, and you see kind of a steady sell throughout the pre-market and then also into the open of the session. Surely there's a little bit of broad market weakness today, but that maybe does explain a little bit of, hey, if you were long this one, you got a little bit of a pop, you like the news, but nothing really to get you excited about what's coming next. So maybe some risk being taken off the table here. But I want to come back to Coca-Cola here quick before we dive into our trade here of the session. But when we look at Coca-Cola, to Jenny's point, this is a huge move for a stock that doesn't really move a whole lot. It pretty much is a steady as she goes stock when you look at it over the last year. We had a trade in here, Scott, where we were long stock and we basically sold a strangle around it. So we combined two strategies, pretty basic strategies, the covered call and the cash secured put. We have it here up on the screen. For the net piece of this covered strangle, we got in at 52.85 on the debit side, and then I sold it this morning. You could probably get out at a better price now at 54.45 credit. So this is a one-day example trade, but pretty capital intensive on a stock that maybe a lot of people are looking at as an investment, a way to kind of trade around your investment.
Yeah, absolutely. And in this move in Coca-Cola, this is actually significant. Here's a stock that doesn't typically move a lot. Even on earnings, it typically doesn't move a lot. We're getting back up towards that upper end here. International numbers were fantastic for this company, and that's what's driving the revenues. That's what's driving the bottom line here in Coke. I think we get to that recent high of almost 56 there, and we blast right through it.
Yeah, we'll continue to monitor that now. We do not have an example trade in there, but one that we always keep our eyes on here. The consumer staples have shined all year as well. Comp sales really the big piece for Coca-Cola. But I wanted to talk Netflix because it was kind of outside of maybe some of the banks to kick off the week. It was definitely the one that had the most eyes on it probably this week for earnings. The N in the FANG stocks. It's FANG Plus Friday. And, there was a huge expectation for a move, Scott, about $30 going into it. And if you look at it on balance here, we're about $7 off of where that move would have been to the downside here. It's been all over the place, but it's really never moved significantly since that earnings announcement. It's been well within the expected move.
No doubt about it. And it did pop up to about, I think, 318, 319 area briefly after the announcement. But the bulk of the trade yesterday after the opening of the market was around 305 until it started just kind of, going lower and lower and lower during the day. So here's one that going into earnings, like you said, the expected move was massive. It was actually over 10%. Typically in Netflix, you see that at about 5%. So the market really was taking into consideration all of the recent news about competition, about international growth really slowing down. And here we are sitting right back to where we were 3 days ago. So somebody that had a position on where they were selling some premium going into this, they cleaned up.
No, absolutely, and I think it might have been a little bit of a case of maybe a short-term memory too, because just that last earnings release, there was a massive move to the downside on a disappointing earnings release here. But Netflix, you read through the numbers, they did pretty strong, but that forecast was so high that it really just kind of came in line, even with basically almost record numbers. It wasn't record numbers, but it was up there close to some. But again, so much competition, so many, speculation around that.
I believe we talked about this yesterday because the initial reaction was so positive. Then if you actually read the report, they did miss on domestic subscribers. There was a few misses hidden in that report. I think they did a good job kind of headlining the positive news, of course, but I'm not surprised to see the stock now kind of selling off.
Yeah. Market psychology. Market psychology. The initial reaction to all the metrics was a good thing. And then I think, calmer heads prevail when you still think about, okay, that's behind us now. We're still going to have this massive amount of competition.
Right, November is still coming up with Disney Plus,
no
Apple
doubt.
TV Plus.
No, so here's an interesting piece though, Scott. We haven't even talked about today's move. We're actually almost down 5% in Netflix today, down 14.44 here, at 279 even on the last trade here. So this is a pretty sizable move to the downside in Netflix. If we're starting to think about trading, does a move like this influence, if you haven't already put a trade on, or if you're looking at example trades, you have to take this into account to maybe even change strategies?
Absolutely, because yesterday my strategy, and we had talked about this yesterday, my strategy was to buy some downside calendar put spreads. Now, we're almost towards those strikes that I had expected, so now I'm going to be looking at this and say, wow, this couldn't hold the rally. It couldn't hold any sort of significant pop here. What is happening? And it just looks to me like we are going to retest, maybe not those lows down at 230 that we got a year ago in the December sell-off. Certainly looks like we're going to retest those lows of a couple months ago or 6 weeks ago around 250.
So Scott, how do you go about trading with using implied volatility for this trade? Because we see volatility got absolutely killed yesterday.
Right, as well it should have after earnings. However, it's up today. So yesterday was the time I really wanted to buy it because it got really cheap. So regardless of whether I thought it was going up or down, I want to buy volatility. Well, how do you buy volatility? You can do that by using time spreads or calendar spreads. And the beauty of those is you can go out and buy your put or your call going out in the future and finance it by selling something that is nearer term. So if volatility does increase, that's going to help the position because that further out option that you own will be impacted more from that volatility pop. Now, today, little bit different story because volatility is up today. However, I would still look to buy some calendar spreads here.
And it's still a fairly muted move in the volatility. If you follow me to the platform here, Ryan, I got the implied volatility study up on the bottom half here. And you're going to see there's a little bit of a peak up to your point, but it is still very much in the lower end of the range in Netflix. And so now the real question is, if you were looking at, say, like the 275 before this move, now you got to find a new level unless you'd really still love that 275, which I'm not sure you do, Scott. So if you're looking at it, we're basically right at that level. You mentioned maybe testing these lows that we made, back at the, middle of September. Is that where you start looking?
So if you can go to the option chain here for a second, and I use this all day long, what is the expected move going out to the time frame I'm looking at? Okay. And I was going out a couple weeks or so looking at that November 1st expiration. So that's why I chose the 275s yesterday based on where Netflix was trading. However, now with the stock trading 280 and you look at the November 1st market maker expected move of around 16 bucks, if I still believe that there's a downside move here, that's going to lend me to start looking at around the 260 to 265 range based on that expected move.
And so if we split the middle there, you get 262.5.
Yeah.
If you're a little bit more bearish, maybe you lean 260. And if you think that maybe Netflix firms here, but still maybe has a little bit of downside, maybe the 265. It's really, where you think this may land, because with a time spread or a put calendar, you're really trying to hit that peak on your strike.
Absolutely, and I like the fact that we're buying a couple weeks here, because depending on what happens the rest of today and next week, I can absolutely roll my short option to another short option perhaps and collect even more premium.
And so if we went to the November 1st, this is the one that you're selling, correct? And you want to go out to about the end of November?
Exactly.
Okay.
Exactly.
So let's say that we did this 262.5 and we went ahead and we went out, let's say, to the November 29th and we bought that one. Right now this is a 348 debit, but we're talking about a $262.5 put calendar. So obviously you're going to see a little bit bigger debit. You also have a couple of weeks. You bought some duration here. So you're going to see a bigger debit than maybe a week over week calendar for those who are watching. But when you start looking at this on the Analyze tab, pretty standard in terms of what we're looking at, very similar to all the other put calendars or call calendars that we look at. You want to move towards this strike.
Not only that, but again, I need to consider volatility. Where is the implied vol of that long option I'm buying going out at the end of November? And if the odds are telling me, that IV rank is telling me that it's very low and the odds are in my favor, that at a worst case scenario it's going to hold where it is, but perhaps it goes up, then that's a benefit to this graph.
Well said. And also a lot of times too with a put calendar, that down move a lot of times corresponds with an uptick in volatility in names. So you kind of get that double whammy of both the directional delta component combined with your Vega component. You also have a positive theta component to this by selling that nearer term put in the November 1st cycle that you mentioned continuing to roll if you get the opportunity to.
Absolutely. And listen, even if Netflix were to rally back $15, $20 here, the value of this put calendar is not going to change that much. It's definitely going to go down, but it's not going to change that much. So this type of strategy really gives me a lot of opportunity, a lot of options, no pun intended, to work with it along the way.
Yeah, a little bit more of a slower moving strategy. A lot of times, a little bit more boring maybe to watch, but
I'm okay with that.
That's
Boring
completely
when it comes
fine.
to trading is okay.
But question for you then, when you're talking to people at Prosper and you're thinking about these kind of strategies, we always like to have kind of an exit strategy for if things even go well. So where would be kind of a profit target on this? If this was trading, $5, would you think about taking this off, $4.25, or where do you kind of look at this and say, that as a percentage return on my risk is a comfortable piece?
So overall, I typically look for about a 70% return. So if I'm paying $3.50 for this or so, I want to see, somewhere close to $6, let's say. Now, I'm not going to get that $6 today, tomorrow, the next day, like you said. There's going to have to be some patience here. However, if we start to get close to that November 1st short expiration, and I'm in this and I'm at the maybe $5.50 range here on a calendar spread like this, I may start to consider taking half the position off, or at that point, even rolling to reduce my overall exposure.
Yeah, so there's definitely some wiggle to this.
No doubt about it.
Some finesse involved, but for the most part, you said 70% kind of your benchmark for looking for what you're looking to return. But if you get the move a little bit earlier than expected, always an opportunity to take it off for any type of a profit, you're going to consider it.
Another old-time saying from the floor, I'm full of them today, bulls and bears prosper, pigs go to the slaughter.
I have heard that one. Yes. But all right, we'll go ahead and we'll round 3 of these at 353 here. And you guys will both be joining me in just a little bit. Jenny, we're going to be talking some Apple.
Sticking with our Fang Plus theme.
All righty, we'll look forward to that. But first, after the break, we're going to bring in the chart master. We're going to be looking at the technicals on the S&P 500. So stick right here on the TD Ameritrade Network Fast Market. We'll be right back. Welcome back to Fast Market. I'm Alex Coffey, and I'm joined by Scott Bauer, the CEO of Prosper Trading Academy, to close out this week. What's been a fun one. Obviously, we got a lot next week, but I want to continue this Apple conversation. We were just talking with Andy Swan from likefolio.com. They love what they're seeing right now with this iPhone release. Obviously, iPhone's still a major component of Apple, even though that revenue portion's gone down significantly over the last couple of years here. But whether it was just a disappointing release last year and phones are becoming a year older, there's more excitement around this one. There certainly is, and the street seems to be liking that too. Apple making basically high after high here at 235.81. It did peak up at 238, but we're right there.
No doubt about it. And I think maybe this new release put a new breath of fresh air into the company, not just for the phones, but maybe that this is going to set off a pattern of some new products, new and improved products. And I think that's why you're seeing the excitement all around the stock at all-time highs, beyond levels that many of the firms have come out with their upgrades. Apple's trading much higher than that. But like you said, the reports on the street of what people are experiencing with this phone, it's like the best thing that they've had in a number of years.
Yeah, and analysts really like where Apple's going right now. Such a difference that 1 year can make in terms of outlooks on companies. Apple seems to always be that company that it seems to, whenever things look dire, really turn things around. But we always talk about how, whether it's Amazon or Microsoft or Alphabet or Apple, all these companies seem to be racing towards building out that full, complete ecosystem. And when you start thinking about companies and how they're coming from it, Apple as that major device component of it with the iPhone, nobody seems almost better positioned than them to really pull that off, and they're moving towards the Apple TV. They're now in the payment space with the Apple Card and Apple Pay. They really just have a lot of things clicking for them, the wearables, the AirPods, everything kind of coming together here for them. But I just want to get your thoughts on how you trade something like this, because we're on the other side of this product release, so that news is out, but we have an earnings release just here on the horizon. Yep. But because it's so liquid and so widely watched and widely held, this is often one that even throughout earnings cycles and into earnings, people have positions, people have shares. So how do you kind of trade around that, even though that's just around the corner?
Well, that's the great thing about it. What you just mentioned is the liquidity. So it's real easy to get in and out here. Now, we've got earnings coming up in, about 10, 12 days or so. So I'm looking at this and looking at the reports that came out, the continued positivity behind it, and I think it's hard to fade that one. A lot of people look at this and say, you got to fade the rally, fade the rally. This is such a momentum stock as well. So what I'm doing right now, and typically I don't play earnings this far ahead, but what I'm doing right now is buying some upside call butterflies, because that is a very inexpensive way to get exposure directionally, and this one happens to be to the upside with the call butterflies, with some really high reward to risk. When I talk about reward to risk, Alex, if you look out to November 29th, so go out 5-6 weeks or so, you can see that expected move here again, that market maker's expected move, right about 16, 17 bucks. So if you look where Apple's trading now, add that in there and you're bullish, that puts up 250-ish range.
250.
So right now, what I want to be doing is just buying a really plain basic butterfly, 240, 250, 260 call fly.
Okay, and so what this is for those watching at home, when you're looking at a butterfly, you're combining a call debit spread, the 240, 250, and then you're actually selling the 250, 260 call spread as well. This creates a butterfly, and basically you want to move towards 250, and then you want to hang out there.
Absolutely. You always want to be at the short strike. Whatever strategy you have, the best place is always at the short strike. So I'm choosing that strike that coincides with what that market expectation of a move is right now. The thing with a butterfly, so the characteristic of a butterfly is typically the price doesn't really change unless one of two things happen. One, you get a big move in the stock, one way or the other, or you get closer and closer and closer to expiration. That's when you start to see those big moves. So much like we talked about earlier with the calendar spread, that this is not a strategy. It's not a plan to get an overnight pop or anything like that. This is one that has to work itself out, but does give somebody nice exposure to the upside for a relatively cheap price.
No, and you mentioned the slow-moving aspect of it until you get close to expiration. Well, that's what this purple line on this risk profile is going to represent. if we made this move today, you see it's a pretty smooth line, but this teal line is going to represent this risk profile at expiration, and you see how sharp this can move if you kind of pin this right at 250. Massive payout for a pretty low risk. You can almost 4x these in terms of risk reward because of that nature of how this component works. But as you mentioned to start this out, a low risk way to kind of get some upside exposure to Apple, but not feel like you're sweating in case you're going to move on earnings that maybe goes the other way.
Absolutely, and even if the stock goes down a couple dollars from here, $3, $4 even, a couple percent, the value of this butterfly is not going to change that much. With the liquidity that's out there in Apple also, very easy to trade around this. If you ever want to adjust the strikes or do anything like that, very, very easy to trade around it. So I look at a setup like this as a stocking stuffer, right? Again, I'm not looking to make money on this necessarily tonight, next week, following week, but it's a stocking stuffer because as we get closer and closer to expiration, that's where the payout is.
Well said, and because it is a little bit lower probability, you need that move to happen. I usually wheel back the size on these trading examples because it's got a big payout as it is, so we have an opportunity to make the money on that way. So we'll just do this one time at the 190 midpoint here. We're going to go ahead and set it. Thanks to Scott Bauer, the CEO of Prosper Trading Academy. That does it for this week on Fast Market. Tune in Monday at 11 a.m. Eastern right here on the TD Ameritrade Network, and have a great weekend, everybody.